Scott, welcome. So it seems like Amazon's costs probably not going down anytime soon, given what's happening in Staten Island, which is one of their larger warehouses, and at least the increased possibility that the movement spreads. So what's Amazon's best move here in terms of cooperating or not in this union push? And what's the impact on investors?
Thanks for having me this morning. I think you're seeing what Amazon's best effort is with the pushback that they're already doing and what happened in Alabama preceding this. Many large companies go through these type of challenges. Walmart in history never did end up with organized labor. UPS has gone in the other direction. I mean, I think it's a cost of doing business one way or the other. What's interesting is, Amazon today nationwide has a minimum wage that's $15. I think there was an Amazon spokesperson quoted over the weekend saying that in Staten Island it's 17 to 23. They also have health benefits and tuition reimbursement. So, where this ends and how long this takes, really nobody knows, but I don't think it's a foregone conclusion that you're going to have a fully unionized labor force at Amazon, based on this information from last week.
Okay. So based on that, you're thinking that Amazon doesn't have to dramatically change its approach to the labor force, it sounds like you're saying. And also, do you think that this labor movement, which is happening beyond just Amazon, is going to raise the cost of its competitors as well?
I think there may be some concessions Amazon makes over time. I think that relative to peers for similar jobs, that the compensation that's offered by Amazon is quite comparable. So, the beauty of a private company and its employees is you always have the option to work elsewhere as well.
Hey, Scott, some of your peers on the street taking a crack at each 1% of frontline labor force that unionizes and what that would do to annual operating expense. One estimate is about $150 million in annual OPEX. Does that make sense to you?
It does. Amazon has about 1.6 million employees globally. There are roughly 110 or so fulfillment centers in the U.S. And so, one fulfillment center, not knowing the labor base in each one, would be 1% or less of those that are involved in actually shipping product for Amazon, which is a portion of the total labor base. So that estimate, ballpark seems reasonable. I think in 2021, in terms of total operating expenses to run the business, Amazon was north of $400 billion.
Scott, it's Deirdre. Broaden this out to the wider e-commerce space. Where are you seeing opportunity, whether that be in Shop, which is still well off its highs, or eBay, which has been an underperformer?
So you had a big pull forward when we were all locked in our houses for a year or so with e-commerce because there were no alternatives to shop. Predating the pandemic, e-commerce was gaining 100 to 150 basis points of market share per year. At the peak of the pandemic, e-commerce gained 600 to 700 basis points. By the end of 2020, that normalized to something like 350. And then there were no share gains in 2021. So when you look at it from an aggregate standpoint, it seems like you had about a year's worth of business pulled forward and then back onto the market share gains that were being had before. Companies like Amazon, eBay, even Alphabet, which is tied to e-commerce, had a similar kind of pull forward, where if you look at their P&L today, from a forecasted standpoint relative to where it was in 2019, it's about a year ahead. If you look at some of these smaller companies, some that have been decimated in this recent correction, the pull forward's been more significant. So companies like Carvana and Etsy, Mercado Libre, C Limited, Shopify, they've had 2 to 3 years of business pulled forward. Now, we're giving a little bit of that back now. It's very difficult to model when you're coming out of the pandemic, and I think that there'll still be a little bit of squishiness in coming quarters. But nonetheless, these companies have pulled forward meaningful period of time, and I think ultimately will march ahead at similar market share gains that they had predating the pandemic once we get back to normalization.
Right. And the pull forward and the valuation reset, do the two match for the most part in aggregate in your universe?
They do. There's not a commonality to the theme in the report. We do go through it one by one. I would say overall that valuations are still a little bit higher than they were before the pandemic. But when you adjust for the increase in the size of the company, argue the stocks are cheaper today than they were in February 2020.
Scott, what about the possibility that, or the argument I'll make, that either Amazon's costs go up significantly here or their velocity slows down, right? If they've got to abide by certain rules, make concessions to workers about, breaks, about length of time worked, any of those things, or if the union's presence kind of slows down Amazon's ability to hire and onboard, are you factoring that in, or is that not a concern?
Well, I mean, Amazon's dealing with higher oil prices and COVID costs related to separating people in the fulfillment center. There's a ton of costs that have gone into a business like Amazon due to the pandemic and because of the inflation, coming out. This labor situation is one more. I mean, I don't mean to discount it too much, but it'll work itself out. If costs go up, they go up. I mean, consumers will end up paying more for the higher cost of the labor force. If they don't, then they don't. I mean, it's not like this is new in history. I mean, you can look at Walmart. I mean, this has happened many, many times, in history, and companies that have won and lost. I gave two examples, Walmart and UPS. Stock performance has been just fine.
All right. Yeah, Walmart managed to avoid union efforts for a long time. Scott Devitt from Stifel, thank you.